Hello, this is Eric Parnell, Chief Market Strategist for Great Value Advisor Group, here today with our latest market insight. Joined once again by Evan Coffey, investment analyst on the team. So what do we have to talk about today, Evan?
Well, Eric, we sat together just over 2 weeks ago, and I felt like there was a lot to discuss then, from the Supreme Court ruling on President Trump's tariffs to tech's kind of slow start to the year. But here we are today, and yet somehow we have even more to discuss with what took place starting on February 28th. The United States and Israel launched joint strikes on Iran and key military and nuclear sites in Operation Epic Fury. The military campaign was launched after negotiations between Washington and Tehran fell through regarding Iran's nuclear program. But I would say that they've really been stemming back for quite some time between Israel and Iran, and from last June between Iran and the United States, when the United States carried out Operation Midnight Hammer, where we, in the middle of the night, went over with the B-2 bombers, as you remember, and struck key nuclear facilities then. So there's been consistent turmoil. It exploded again on February 28th. And in response to these latest U.S. and Israeli attacks, Iran launched with what I felt like were haphazard, kind of indiscriminate attacks on many of the Gulf states in the region, including the UAE, Qatar, Saudi Arabia, Jordan, and Kuwait. Major damage has been dealt by both sides, with the biggest headline coming on the first day of the attacks. This was that the U.S. had killed Supreme Leader of Iran, Ali Khamenei, and many other high-ranking officials. Since the Ayatollah's death, his son, Mojtaba Khamenei, was appointed by the clerical body responsible for selecting Iran's highest authority, but he is also reportedly wounded. That came out last week as well. On the United States side, unfortunately, last week 6 U.S. service members were killed after their KC-135 refueling aircraft reportedly struck a different U.S. KC-135, although that hasn't been confirmed. I would say high level that the focal point of the conflict has been the status of the Strait of Hormuz, which is responsible for 20% of the world's oil shipment. Iran has imposed a de facto closure of the strait by threatening commercial ships and even attacking some, although that mostly took place in the first week. Oil volatility because of this has remained elevated due to what has essentially been a supply choke. Brent crude has reached more than 105 a barrel, with West Texas Intermediate reaching more than or close to 120 a barrel at their peaks. Both have settled to around $100 a barrel at the time of filming. So this week, in terms of the status of the strait, the UK and the EU have been in talks with President Trump about reopening it, using robotics to sweep the bottom of the strait for Iranian mines. But generally, President Trump has called for international help on this, and he hasn't gotten much response, which I found interesting. So I know that this is a pretty extensive rundown, but I think it's important for us to address because I certainly have heard it from some of our advisors, but also just retail investors, the consternation and kind of the fear of this geopolitical risk and what this means for their portfolios. And maybe more broadly, could this spider web out into other geopolitical conflicts, whether it be something involving China and potentially Taiwan, or something involving Cuba? So as chief market strategist at GVA, I would love to get your take on what investors should be doing, how they should be feeling, especially if they're worried with news like this.
No, it's a great question, and it's an understandable concern for investors as we go through 2026. The first thing that should be stated is that whenever you have a military conflict like this taking place across the globe, there's certainly a human impact to that, and it can't be overstated the human toll that this takes. And it's so with that being said, when it comes to the markets, this is really not likely to be a sustainable event for the markets. When you have geopolitical conflict like this, it brings uncertainty. And that uncertainty has an understandable negative effect on the markets in the short term. You see, equity markets pull back. You'll see maybe concerns about inflation, particularly given the region that we're talking about in the Middle East. You'll see concerns about inflation increase. But we have 150 years of market history that tells us over and over and over again that there can be short-term turbulence in the market, but once we get some clarity around how things are going to play themselves out, the market has historically stabilized, and more often than not will end up higher than it was before the conflict started. And the situation that's unfolding in Iran is no exception. Basically, we have a circumstance where there was an attack on Iran. The Strait of Hormuz, as you mentioned, has been effectively closed. The military, the ability of the Iranian military to retaliate has become increasingly diminished. It is only a matter of time before we start to get some certainty around the Strait of Hormuz reopening, around some either glide path or resolution to this conflict. Once the market gets comfortable with that, a forward-looking mechanism in the markets, we're likely to see the markets respond. From a technical perspective, we saw the S&P 500 fall back to its 200-day moving average, its long-term trend line. It bounced off of that. This is the type of disciplined and calm behavior that you would see in a market that, yes, it's moving lower, but it's rationalizing what it's doing. So I would suspect in the coming weeks, we'll see the markets increasingly stabilize, and we shouldn't be surprised if it's bouncing back the way that it has so many times. We take a look at 9/11, we take a look at World War II, we take a look at the Kennedy assassination. History, time and time again, shows that outside of short-term uncertainty, the markets bounce back from these type of geopolitical events.
Yeah, and I think that, it sounds like what you would be saying to investors is, hey, stick to your long-term investment plan. Don't do anything irrational. As you said, we have anecdotal evidence and historical evidence to point that, we're going to come out on the other side of this. I want to unpack some of the financial metrics you talked about and some of the implications on financial markets pertaining to, what's taking place in the Middle East. As we discussed, oil has been elevated, and you made mention that, we should be keeping a watchful eye on inflation because of this. The 5-year break-even inflation rates have gone up about 20 basis points since February, but that isn't overly alarming to me. The 10-year has gone from below 4%, topped out at around 4.3%. It's settled in at around 4.25%. You mentioned equity markets. The S&P is off about 2.5%, although it's rallied to start this week. NASDAQ down about 1.3%. So market reactions have been negative, which I think was expected, but they haven't been as visceral as I think most people were initially anticipating. So my question to you to unpack the financial implications of this a little bit more is, first, we have seen probabilities of a cut have moved lower. We're no longer expected to get a cut midsummer. It's now been extended out to December of this year with only one cut baked in. Has the Fed's course drastically changed because of this? What is the market outlook now for equities? Just talk to me a little bit about what you think the financial implications of this conflict are moving forward, and maybe what we should be looking at.
Yeah, so one of the big things we've seen with this conflict is there's been a spike in oil prices. Oil prices were, in the $50 per barrel range not that long ago, and now we're talking about oil pressing $100 per barrel. And that can be alarming to people to say, hey, does this mean that we're going to have higher oil prices at the pump? Does this mean that corporations are going to have to spend more in order to produce products, squeezing their profit margins and maybe cutting into profitability? Those are things to keep our eye on, but it's important to put what's taking place in the oil market today in broader context. Yes, we've approached $100 per barrel in West Texas Intermediate crude, in Brent oil prices. But if you go back over the last 20 years, we were well over $100 a barrel a couple of years ago, and that didn't lead to a sustained inflation problem. We had a spike in inflation, but that problem in inflation was brewing before Russian invasion of the Ukraine. That was building from all of the COVID stimulus that went into the economy, and that goes all the way back to 2021, long before Russia invaded Ukraine. You go back to the first part of the 2010s, first half of the 2010s, oil prices were consistently above $100 a barrel. You go back to before the financial crisis, we had oil prices peak at $147 per barrel. And that's in 2008 prices. If you do inflation adjust that, that's the equivalent of oil prices being over $217 a barrel 20 years ago. And we didn't have an inflation problem back then. I have been talking for the last couple of years that inflation is the number one primary downside risk for financial markets. And this is not likely going to be the issue that sparked that. You talk about break-even inflation expectations, the expected average inflation over the next 5 years. Before the attacks in Iran, the break-even inflation rate was at 2.46%, which expected inflation over the next 5 years of 2.46%. I'll take that all day long. Where is it after several weeks into the Iranian conflict? It's at 2.58%. That's an addition of 0.12 percentage points. That's nothing. What that's saying is that the market is feeling calm about inflation expectations as this conflict continues.
Yeah, and I think that once again, it just signals that, at least from what you're saying, that investors just need to stick to their long-term investment plan. They need to focus on what they've built with their financial professionals, and not necessarily get caught up in the headlines. With that being said, the final point I want to unpack with you is something that you have said especially to the team here at GVA, is a risk on your radar, and it's not in geopolitics. It's not in what many are calling the faltering AI trade, or the slowing of tech's performance. It lies in credit. A flurry of headlines have plagued the private credit space, and recently it looks like this has started to spill over into public credit. Last week, JP Morgan marked down certain loans to private credit funds, particularly in sectors exposed to technological disruption like software, due to a concern that their credit quality might not be where it should be. Several major private credit funds, including those managed by Morgan Stanley and Cliffwater, have capped their redemptions after facing outsized requests. Cliffwater's $33 billion flagship fund capped redemptions at 7% when investors were looking to pull a record 14%. On Morgan Stanley's side, that North Haven private income fund with $8 billion in assets, in the first quarter, investors were basically redeemed 169 million. Basically half of what they were looking for. So we've had this flurry of headlines. I feel like the biggest one was the news out of Blue Owl, where Blue Owl essentially sold $1.4 billion worth of loans. And it is important to note that they did this, and they made it abundantly clear that this was on market terms. There were no incentives, there were no backstops, and the loans were sold at 99.7 cents on the dollar. So they were sold in proper order, but this is still a jarring headline within the private credit space. And as I said, it looks like this is potentially spilling over into the public credit space. You and I just talked about CCC spreads. I wouldn't say that they've blown out, but they've risen steadily through this news. They're pushing 9.8. We've seen XLF, the Spider Select Sector Financials ETF, down north of 10% to start the year. And some of these major private credit players like Blue Owl, Ares, Apollo, they've had incredibly rough starts to the year. Blue Owl down almost 50% year to date. So, you have been strong in voicing to the team, hey, this is something that we need to keep on our radar. And my question to you is there a risk for a contagion effect? I don't want to fear monger on here, but is there a risk that we're facing something similar to an '08, or heaven forbid, something like close to a century ago in 1929? Like, do we need to be worried about this at larger scale?
No, it's such a great question, because we talk about Iran from a market perspective. I'm not worried about Iran in the long term. Could it continue to have short-term effects? Yes, but I'm not worried about it in the long term. But when you talk about what's going on in the credit markets, private credit, when you're talking about what's going on in what was once the AI boom, now I refer to as the AI arms race, that's something that we really need to keep an eye on from a downside risk perspective as we go through the rest of 2026 and into 2027. Because, if you take a look at what's gone on in technology, it was euphoria. It was a party. Anything that was related to AI was going to the moon for a few years now. But we've reached a juncture where it's becoming competitive where we're going to have to differentiate winners and losers in the AI space. And that includes, from chip production to hardware to software to all facets related to the AI trade. And that has some spillover effects into credit because there are a lot of companies, a lot of public financial institutions, a lot of private credit firms that have lent just a ton of money into the technology space. And as we start to differentiate winners and losers, those losers are going to feed through to those who lent money to those who are the losers. And a lot of money has been lent in that space. So there have been some false alarms that we've encountered in recent years. You think about commercial real estate. There was all kinds of fuss about commercial real estate back in 2022 and 2023. You say, we had the COVID crisis and nobody's going back to the office, and there's all these office buildings that have been lent, millions and billions of dollars that are going to default. Well, that really didn't turn out to be an issue. So the question becomes, is what is starting to unfold here in the credit space in 2026 and 2027 that's tied primarily to technology, but also is tied to the fact that all of these private credit firms for so many years were lending to pretty much everybody. So there's going to be some bad loans out there. As that plays itself through, does that have knock-on effects to the broader economy, serves as a constraint to growth, and starts to pull down the markets? Geopolitical events aren't things that bring down markets in the longer term. Liquidity events are things that bring down markets in the long term. And when you're talking about credit, when you're talking about lending and borrowing money, those are the types of things that draw liquidity out of the market. And if you're drawing liquidity out of the market, those are the things that make stocks and bonds go down in price and value. So that's the biggest thing that we're going to need to watch here in the coming months, is how does this all unfold?
Yeah, and that's what I was going to echo to wrap things up here is that, we'll continue to monitor the situation in the Middle East. We'll continue to keep investors and advisors informed in what's going on over there. But really where we want to keep focus and keep the audience informed is, the situation within credit markets and, kind of as a secondary, the AI trade. So Eric, it's been great talking with you today. As always, I enjoyed it.
It's always great talking with you, Evan. And thank you for joining us for this latest Market Insight. And we look forward to seeing you again soon.